So cool. So we're going to start right from form is simple. That's just a family, occupation, recreation. That's how we build rapport in the home. That's very easy to learn. So we're going to start right from your role and purpose. We'll do that. Cool. Awesome.
Well, Tim and Danielle, I'm privileged to be here. Thanks for inviting me over your home. I just want to be really straight up with you guys. I'm not here to sell you anything that you don't want. You guys filled out the form, you mailed it in, you invited me when I called you over your home. So that's why I'm here. I'm here to get you some peace of mind, as long as it makes sense for your goals. And of course, as long as it fits your budget, right? It has to make sense financially. Fair enough?
Yeah.
Good. Awesome. That's great. Well, as I've explained to you already, Symmetry gives me the opportunity to have a whole bunch of tools in my tool belt. So with over 30 carriers to work from, I can pick, that's the wrong word. I can pick the right product and the right carrier based on your situation and where you're at here as well. So, I want to let you know a couple things. First of all, what this is not, you can laugh, it's okay. What this is not PMI. PMI is required if you don't, put down at least 20%. Did you guys do that?
No, we just did 5%.
So you get PMI you have to pay?
Yeah.
Yeah, that doesn't protect anybody you really care about. It just protects the bank. If they have to foreclose, they want to finance their middleman to liquidate your property. It's not PMI at all.
Okay.
What this is this is a protection, peace of mind that it provides so that you are able to protect your loved ones.
So how does this work?
How does what work?
So you spoke to her on the phone?
Mm-hmm. Yep.
Okay. So do I have to buy anything today?
Well, what I'm here to do is to let you know what you qualify for and then custom fit that coverage for you based on what your budget is. So that's what I told you about. That's what I said. It's, I'm not going to twist your arm. I'm not going to manipulate you. This is your peace of mind. It's not mine. I didn't come here with something that I'm hoping to not lose. This is your peace of mind. So I'm going to let you know what you qualify for and then make sure that coverage not only fulfills what you're looking for, but at the same time, it fits your budget, affordable financially for you. Okay, so it's not PMI. This is also not decreasing term insurance. That used to be pretty popular back in the day. The idea is that, you've got your $300,000 mortgage, you'd have $300,000 worth of coverage, and then as time goes on, they both end in zero. They decrease over time, but you keep paying the same amount. All of our coverage is consistent. The premium never increases, the coverage never decreases. So you can count on it, you can bank on it, you can budget it in very easily as well. This is also coverage that is it's now portable. So back in the day, if you refinanced or you sold your home, it would cancel the coverage and you'd have to reapply at the then current rates. And if you were older, which most people are over time, it gets more expensive. This coverage is attached to you as people. So wherever you live, that location, that property, that home, wherever, that condo is protected as well. I guess if you wanted to, you could go out to Walmart, buy a tent, live out in the woods for the rest of your life. You'd have one heck of a well-insured tent, right? So the idea is that it's attached to you guys. So no matter where you go or where you live, the protection's there. A couple other really quick things. This coverage is now non-medical, so nobody comes over to the home. You don't have to pee in a cup. They don't draw your blood. They don't put you on a scale. I am the licensed field underwriter. I ask you the scary questions. We then go ahead and pick the right program for you and then submit it to the carrier. And then they go ahead and they make the decision. They think about whether or not they want to bring you on as a client. Just like you told me in the very beginning, you've been thinking about this for about 3 to 5 months. They have to think about it too, right? Last but not least, I want to point this out as well. Traditional life insurance works really well for the beneficiary financially if the insured dies, but we're here to do more than just protect your number one asset, which is probably your home, right? You don't have any other big investments. We're here to protect your number one asset, which is your ability to earn an income. Now, I know you guys are in your 70s, but I just want to paint a picture here to help you understand how this works. God forbid something happens to your health, substantial, whether you're diagnosed with a terminal disease or, depending on the policy, a critical illness, chronic illness. If you were still working and still counting on, that income, If you're, if you get a terminal disease and you're trying to fight this thing, you're bedridden, 6 months, you're out of work. I don't know a whole lot of companies that'll pay you to lie around in bed all day for any reason. And these policies give you extra peace of mind, because if indeed that was a situation that happened to you, you can actually take money out of the policy in advance of your death. You'd give me a call, we'd sit down probably at this same table, and then we'd go ahead and file a claim. Your doctor, not theirs, but your doctor would go ahead and fill out the form and submit it to the carrier. You would be able to pay off the home while you're still alive, pay for bills, whatever, medical expenses. It gets very expensive very quickly. So those are a few things that are very unique about this product. Does that make sense? So far, so good?
Yeah.
I want to show you guys something. This is really simplistic, but most of my clients really appreciate the simplicity of this illustration. I guess it's just that I'm simple-minded, but as long as I explain it well, I think it might make sense for you guys. Now, I know that your loan right now is $300,000, right?
Yeah.
So if you had to sell the home for whatever reason, what do you think you could get for it? What was the listed price, the contract price?
About what we paid for it.
Okay, about $300,000.
Yeah, 330.
Okay, 330, just a little bit. That's a good example. So obviously what's gonna happen is this, right? So over time, as you're paying off the house, this is gonna go down, right? What you owe is gonna go down. Now, historically speaking, property values go up, which is why there's such a great investment for most people. Now, obviously, the market adjusts here and there, but if you zoom out, I mean, it's doing this. Like 20 years ago, there's no way you could get $330,000 for this house, right?
Right.
You can now. The difference between what you owe and what it's worth is equity. Right now, it's only $30,000, but as these go in opposite directions, your equity is gonna go up, right? So we gotta protect this as a bare minimum. Because what happens if you don't make your mortgage payments?
We could lose a house.
The PMI kicks in, they finance the middleman, you lose your house, right? And they take everything, including your equity. Did you know that?
I've never really thought about it.
All of what you've put into it, what you've earned over time, it's gone. Until this is paid off, this is at risk. I don't know about you, but there's no way I'm gonna let my bank put their hands in my pocket and take out my $30,000. That's my money, right?
Yeah.
Okay, anyway, there's 3 ways that we protect the mortgage, and everybody assumes that there's only one. All right, the first way that we do this is known as a payoff plan. That probably sounds pretty familiar, right? So I'm gonna specifically call this a full payoff plan. So it's pretty self-explanatory, but if something happens to you, I'm gonna pick on you as an example. Is that okay?
Yeah, it's fine.
If something happens to you, this plan would give your wife enough money to write a check and take care of the entire mortgage balance. Make sense?
Yeah.
Sounds good?
That looks good.
Nope, doesn't work for about 2/3 of my clients. Makes no sense. Number 1, their age may not be what it used to be. Number 2, their health may not be what it used to be. Number 3, maybe they don't wanna pay 2/3 of a mortgage payment to protect their mortgage. It just doesn't make any sense. And so a percentage of them will actually walk away assuming that they can't get any coverage, they can't protect themselves. And that's unfortunate, because there's 3 ways that we can do this, okay? So another third of my clients would qualify better, not for a payoff plan, or it's gonna actually still be called a payoff plan, but not a full payoff. We're gonna call this one a partial payoff, okay? So basically, a partial payoff is anything less than what you owe right now. But remember when I told you that all of our plans, the coverage is consistent? It never goes down, the price never goes up. So at some point, even if you do a partial payoff, right? At some point, your mortgage is gonna continue to go down. These items, this will basically intersect. So if you do a partial payoff, say it's $250,000, yeah, there's a gap between what you have in coverage and what you owe, but eventually it'll be a full payoff, and then you'll have a surplus. You can repurpose these funds for whatever you want, okay? So let's just say I didn't want to do $300,000 worth of coverage, but I did want to do $250,000. Now, if you're like me, you might be thinking to yourself, why the heck would I do this if that's what I owe, right? Well, I'm gonna do this. This is a financial strategy that the insurance carriers don't necessarily like us to talk about, because they want you to believe that you gotta get the full payoff, right? Let me ask you this. Say that you're the beneficiary, okay? Still picking on you, okay? If you have $250,000 in the bank, are they gonna take your home?
No.
No. No, the point is that there's a lot you can do with $250,000. You can have one heck of a funeral, put the word fun back in funeral, right? Okay, and then you can have X number of monthly mortgage payments, okay, to grieve, to decide, what are you gonna do with the home? Do you wanna keep the home? You know, maybe by this time you're 85 and you don't really wanna keep the home because, I don't know, there's too much maintenance, you know, and it would be nice to have a maintenance-free condo maybe, or whatever. Either way, you take whatever's left of that $250,000, you apply it as a principal payment against what you owe, and you refinance. And now all of a sudden, instead of paying $2,200 per month for this, you refinance and it's $1,000. Now, in some situations, this is not affordable, but that $1,000 just might be.
Yeah.
Make sense?
Yeah.
Plus, it's cheaper because you're getting less coverage.
Yeah.
Now, there's a third option I want to really focus on, and this is ideal in situations where, you know, perhaps it's a retired couple, maybe yourselves, I'll ask you in just a moment, but they know for a fact that if one of them dies, they know they're gonna have to sell the home. Now, pause, at some point, usually, you know, some of my clients will say, well, if I die, he or she will just sell the house. Okay, and therefore I don't need this insurance. Okay, really? So, let me just get this straight. So, you're gonna come home from the funeral, you're gonna decide what needs to be boxed up, what needs to be thrown out, what needs to be kept in storage, you know, moved to a new place. You're gonna have to find a new place to live, get a real estate agent. You're gonna have to figure out, you know, okay, so let's scrape together a few $1,000s to figure out what do we need to do to the house to get it so that we can get it listed. Hope to God that the market is really, really hot at that time, whenever that is, and get the house sold in 2 weeks. Really? I mean, it takes time to sell a home because the bank is looking for their next payment. They don't want their $300,000. They just want their next payment. They don't care where it comes from. So what usually ends up happening in situations like this is you've got families that are desperate. You've got a survivor, a beneficiary that is desperate to unload the house because they already know that they're going to be homeless. They don't want to go bankrupt as well, and they know they can't afford this. And so here's what ends up happening in most situations like that. They have to lower the price of the home to move it quickly, right? Guess what they give up in order to do that? The equity's gone. The bank still puts their hand in their pocket and pulls out the money. So these policies, this third option, I nickname this, I nickname it the equity protector, but at the same time, instead of a payoff plan, I call this the payout plan. What it does, it's not even what it is, it's what it does. What it does is it buys time. That's what this does. See this right here? These little lines representing how many months of mortgage payments? That's what this is. Now, there's a couple things about this that are really good. Number one, these policies only expire when you do. They never run out like these. 10 years, if you're lucky, 15 years, whatever it is. And then it's almost like you're hoping to die before the end of the policy, right? And because if it happens, then you've spent a whole lot of money for nothing. These policies never expire, plus they build a cash value. Now, it's not a good savings account, so don't look at it that way. But the way I like to say it is, you know, if it's 10 or 15 years down the road where you win the lottery and you just don't need this coverage anymore, you can cancel it and get thousands of dollars back, right? So these policies buy time, right? So if something happens to you or to you, the other person is able to get enough money to float this full mortgage payment for a year and a half, depends on what you are comfortable with and what your budget calls for. They're able to, you know, therefore what you do is, you know, it's a lump sum payment and you can draw from that every month, okay, to keep this price as inflated as possible, okay, get the best possible price. You don't have to jump at the first offer. Wait 6 months, wait 8 months, wait a year if you want, right? And then you walk away with whatever your equity is if you already know that you're gonna sell the home anyway. Does that make sense? Do these three options make sense?
Yes.
Yeah.
They're all a little bit different based on what your goals are. So let me ask you guys this. All right, have you had this really uncomfortable conversation yet about what would happen if?
No.
It's good that we're doing it now, right? I've had conversations with clients where it is too late. That's a horrible conversation to have. So I just take my hat off, if I had a hat, that you guys are doing this now. You're planning ahead. It's good for you. So what would happen? Is there a primary, we call it primary breadwinner here, where, you know, if one of you died, you know, the opposite party would be in a more difficult financial situation than the other? Why am I here? We talked a little bit about it on the phone, but why am I here? You said that if either of us dies, we can't keep the home.
Yeah, I just wanna make sure she has something.
Right, good, yeah. What would happen if the situation was reversed?
If she passed away, it'd be a little bit of loss, but I think I could take care of everything.
Financially?
Yeah.
Yeah, I hear you. So what we can do with this too, since it's two separate policies, is that we can put more coverage on the primary breadwinner to protect the non-primary breadwinner, and a little bit less on the secondary. And the reason for that is, I mean, I don't know about you, but like if the love of my life died, I probably wouldn't want to jump right back into work, or just, you know, I need some help, just, you know, relaxing, paying for bills, what have you. So we don't need as much coverage, so those are custom designed for each of you. Yeah, so how long would it take for you if your husband passed away before things got really critical financially?
Well, I would feel it right away, cause like I said, he's the breadwinner, so if none of the funds are coming in, then, I would be in a lot of trouble.
Sure. Yeah, this is why I'm here, just to help make this, I mean, this is obviously important to you. You're sitting here too, right?
Yeah, I have a little bit of money stashed away, that could help when she's gone to stay out of work, but.
Great, yeah, yeah. That's good. How long would that last, do you think?
About 10 grand.
Okay. So it wouldn't last too long? What would happen then? What would you do then?
I would lose the house, I would have to sell it.
Okay. And there we are again with this whole thing. How long is that gonna take, right? Obviously, it would be nice for you to not have to change your lifestyle. It'd be nice to not have the stress of dealing with trying to sell a home at the most tragic time of your life, you know? And then you have to grieve on top of all of that, try to figure all this stuff out. Do you think the kids would help? Your adult children? Take you in, maybe? Is that a possibility?
Maybe, one of them lives close, but one of them lives, 2 hours away.
Okay. What do you think that they would wanna do? Let me ask you first, what would you wanna do? Would you wanna keep the home?
I think they could pitch in and help me pay the mortgage, so I think I may be able to stay.
Good, yeah, that's great. Options are good, aren't they?
Yeah.
Any kind of options, as opposed to not having anything but, oh my gosh, I gotta sell the house like right away,
Right.
right? Yeah, yeah. That's what I love about this third option too, because it provides options. You have options to figure out what to do, gives you time to figure that out, to think clearly. And, you know, plus, you know, like I said, you know, you've got all the benefits of that. Options are a good thing, and I'd rather be the one to decide what those options are than having somebody else decide for me, right?
How much is that option?
Yep. Well, I'm not gonna make any assumptions. I'm not gonna assume that you don't want the most coverage that you qualify for. I'm gonna certainly let you know what that is. But based on these three options, you know, which do you think makes the most sense for you guys? Going with like 10 years and then it's over? Trying to cover the whole house? Or the third option that we had talked about before, which is to give you some time to decide, and then options.
I mean, it would be nice to have the whole house paid for her.
Yep.
That would be nice.
Sure would. What about the third option though, being the, you know, as far as, like I told you, I'm not gonna make any assumptions, I'm not going to, you know, assume that you don't want the most that you qualify for. Would you be comfortable, for example, if the price was, and like I had said before, if the price, you know, was pretty substantial, would you want to pay off the home, and only have 10 years of coverage?
So it's a risk.
Pretty substantial.
You said the other one lasts forever?
The other one lasts as long as you do. So it never increases in premium, price never goes up, the coverage never goes down. I guess what I'm saying is, I'm here to recommend something, but we spend a few extra minutes just to understand what your goals are. And some people are okay, I guess, spending, I don't know, $1,000 a month, getting themselves covered for 10 years. And then it's like, I hope I die in time so I don't throw all that money away. It just,
Yeah, I wouldn't want that.
you know what I mean? It just, you don't have to spend as much as some people want you to believe you do. And I mean, if you said, yeah, I wanna do that, I don't know if I could recommend that, honestly. You know what I mean? I wouldn't feel good about it. I wanna make sure that you guys get, the peace of mind that you're looking for, but it has to be affordable, right? I mean, unless you get, I don't know, $1,000 a month kicking around.
No.
I wouldn't encourage you to invest it in a life insurance policy either, though, if that was the case, for $1,000 a month. Yeah, so based on these, you're gonna qualify readily for this plan. And I just think that makes the most sense for you guys based on what your goals are. Even if your kids, wanted to come and move in, this gives you time to get that arrangement, What if they decided at the last minute, excuse me as I spit all over the place, what if they decided at the last minute, we don't want the home, we wanna get rid of it? Well, you still have a year or longer of mortgage payments that you have, and you can do that. And then you don't have to feel that stress,
Right.
I just wanna make sure we're on the same page,
No,
right?
that makes
Yeah,
sense.
that
Yeah.
makes sense.
So as far as this third option goes, I just wanna make sure, you understand all three though, right? So
Yeah.
you've got the full payoff, the partial payoff. I think we've established it just doesn't make sense, since maximum would be maybe 10 years of coverage and then it's all gone.
Yeah,
Whereas this one gives you, mortgage payments, time to grieve, time to get the house on the market if that's what you wanted to do, what have you, right? And then, it builds the cash value, it never runs out and all that. Sounds like we're on the same page now, is that
Yeah.
kind of the best plan for you?
Yeah, I want it to last
Yeah.
forever.
Good. Well, again, it sounds to me, based on our conversation so far, that you guys understand what's at stake. And you sound like you really wanna make sure that your wife is protected, and then vice versa, I'm assuming too, right? This is important to you?
Yeah.
What would be your plan? What would be your ideal plan, based on how things are at right now with your finances, with, whatever, your present situation is? What would be your plan right now if we don't move forward with any of this to get your wife protected?
If I died today, got that 10 grand, that would go in like 6 months, 5 months.
Okay.
And, I don't have a plan.
Okay. Do you have any other, any other assets, any other coverage, anything
My
else
car's
that,
paid off.
that's really good? That frees that up, a few $100 a month, that's awesome.
Mm-hmm.
Any other coverage that you have, any other thoughts that you have in
Yeah, I
your
have
mind?
something through work.
Okay, good. Oh, like a group life insurance policy?
Yeah.
That is awesome, congratulations, smart move. I tell people all the time, so this must be, you're retired though, right now, right? So you just carried that on, they let you transfer it over?
Yeah.
Okay,
Small.
that's so good.
It's like a funeral thing.
Okay, so that'll take care of funeral expenses and what have you, okay, well, that's good. So then, I tell clients all the time, if you can get any coverage through work, get as much as you can afford, cause it's the cheapest you'll ever pay, but just don't count on it, because if the job ever changes, or they unilaterally decide to change benefits, you're stuck without a safety net. So I look at that as extra. Think of that as like an extra layer of frosting on the cake, right? What we have to do is get your home protected, right? Okay. Can I share with you guys how I can get you this peace of mind?
Yeah.
Okay, well, let me tell you how this works, okay? The first thing I wanna do is just really quickly review the medical information. I know we just did it on the phone a few days ago, but I just wanna make sure that nothing I've forgotten, because it's my job to get you covered, not to get you declined, right? The second part of that first step is a very quick financial snapshot. It's just cash flow, income, expenses. I just wanna make sure that what I'm recommending makes sense for you guys, but the ball is gonna be in your court. You guys are gonna be able to decide that on your own, right? The second step is that you then choose the options, or the options that make the most sense for you guys. And then the third part, which is the most important, if I do the first two well, which I fully intend to, is that we need to go ahead and submit the application today, before I leave. And let me tell you why. Number one, I don't know if I can get you covered. Okay, I'm gonna make a really good educated guess based on my field underwriting experience, but ultimately, it's not even up to me, it's up to the carrier. And the only way that they'll even consider you guys and think about you, bringing you on as a client, is if I submit to them a complete application that's in good order, which means all the scary questions have been asked, that's my job. The payment information, the coverage amount, all that needs to be submitted to them. But I wanna be straight up with you guys, I hope you know I've been that way up to this point. We're not submitting anything until you know how much the coverage is and what it will do for you, and you'll feel great about it. And then you'll know what the price is that you're investing every month, and you'll feel super comfortable about it, okay? Doesn't make any sense, if we're talking about peace of mind, for you to sacrifice present peace of mind for future peace of mind. If this costs you 3 days a week of eating, then it's too much, okay? Fair enough?
Yeah.
I wanna make sure you understand how the process works going forward and that you're comfortable with that. That we are gonna submit an application today after I do my hard work getting this program to a place where you're very comfortable. Are you comfortable moving forward?
Yeah.
Okay, so based on what I see here in our conversation, you told me that you have no medical conditions whatsoever, except you're on one high blood pressure medication, each of you? Are there any other medical conditions, heart conditions, sleep apnea, stroke, cancer, diabetes, COPD, anything else?
No.
Never, okay. Any medications other than the one single high blood pressure medic, the lisinopril for both of you? Any other medications at all, prescription going back 7 years even? Not including like an antibiotic or something like that?
No, nothing major.
Okay, okay, that's great, that's great. Now, I know that your monthly payment is $2,200, right? Do you want me to go through this? Keep going? Okay. $2,200. Now, is it oil heat or is it gas heat here for the home?
Gas.
Gas, good. Now, you've only lived here for, you just said, like a couple months, right? Okay. Did the utility company give you any ballpark of like about how much it costs to heat the place in the winter? It's okay if they didn't.
It's about $250 a month.
Okay, good. So what I like to do is overestimate expenses and underestimate income, right? So we're just gonna annualize this, and I'm just gonna say $200 a month year round. Does the gas also heat the hot water heater, do you know?
I don't know.
Maybe electric, either way. Electricity, you have central air, it's a nice home. All right, so, and you get 3 bedrooms, right? And so I'm guessing it's about 2,100 square feet for this property, the building. So I'm gonna overestimate that and just annualize it to about $250. What was your most recent electric bill? Just a guess.
200.
Okay, so we'll just do $250 for the heck of it, all right, great. Now, water and sewers every 3 months, got it, okay. How much is have you received a full 3 months yet? No, because you've only been here 2 months. All right, and how many are living in the home? It's the 2 of you and that's it?
Yeah.
Okay, yep. So I'm just gonna say $40 a month, because they'll bill you every 3 months. Okay, groceries, you go shopping every week typically? What's your typical grocery bill, would you say?
About 200. And just out of curiosity,
Yes.
do you need all this information?
That's a very good question. The reason why we do this is because, as I told you, remember before, the way the process works, is that I wanna make sure that what I recommend makes sense for you guys based on your situation. So I'm not gonna ask you any, personal details or whatever, but this just gives a good snapshot of kind of where we're at financially as far as that goes. I don't wanna even recommend something that doesn't make any sense for you at all, okay? So the groceries, do you go every week or every couple weeks, would you say, a couple times a month?
Every 2 weeks.
Okay, maybe $100, $150?
About 400 a month.
400 a month, good, okay. Cable TV, what are they getting you for?
We don't have cable.
Nice,
That's
just
TV.
internet?
Yes.
Yeah.
There you go. Yeah, I keep meeting clients and they're like, I just do Netflix and Hulu, that's all I do. Good for you. I saved about $100 a month on my cable TV by, giving them the pink slip. So what's that, about 85 bucks?
107.
107, there you go. All right, great. Okay, so mobile phones that you pay for?
Yeah, they're expensive.
How much are you paying for those?
$230.
Wow, all right. prepaid is the way to go, but good for you. All right, credit cards, do you throw money at them every month just to keep them under control? Do you pay them off every month?
We pay money at them every month to keep them under control.
Yep. So just look at the cash flow. So about how much money would you say goes out to credit card companies in a typical month? On average, I know it's different, but take a median.
About $300.
Got it. Cool. Savings, money that you take aside out of, your retirement, you put aside on purpose, or is it just whatever you can, whatever's left at the end of the month?
I try to put $100 a week away.
Okay, so $400 a month, and that's pretty consistent, right? Okay, so we'll count it. Great. Okay, car payments.
I own mine.
Nice.
Mine's $250.
$250. And you own and operate 2 cars, then, right?
Yeah.
Yes.
How often do you fill up the tank? Once a week?
Once a week. About $40.
40 for you, and
That's the same.
okay, so 8, 16, 24, 320 a month for gasoline. All right, car insurance.
100.
About $100, good. Any other substantial expenses? I'm just covering the main household expenses typically, but any other substantial expenses that you guys have?
No.
The dog and special food.
Oh, the dog food.
The dog special food must happen, yes. And how much is that?
Probably like $100 a month.
Lord in heaven, okay,
Yeah,
all
I
right.
sell the dog.
Dog food, all right. Any other things that you can think of, any other expenses? I'm just gonna throw another couple $100 in just for miscellaneous, there's always stuff that comes out, right? Okay, checking account, do you maintain a substantial balance, like a buffer in there, or is it just all the money goes in and then it all goes out to pay bills?
Yeah, that's usually what happens.
In and out?
I like to keep $2,000 in there.
Okay, about $2,000. Separate savings account at all?
Yeah, the one that I told you about, $10,000.
Yep, 10 grand, gotcha. Okay, retirement, obviously you're taking, receiving some, is it through Social Security, is it like an annuity payment?
Through Social Security.
Okay, got it, yep. Do you have any pensions, anything else lined up? Okay, got it. All right, so obviously, Tim, your income is helping to pay these bills. So what is your monthly take-home pay after all the deductions are taken out? It's not pay, it's your income from Social Security.
$2,800.
Okay. Any other income for you?
No.
Okay. All right. Great. Danielle, how about you?
Do you remember mine?
Yeah, it's about $2,200.
2,200. Okay. Great. Yeah. So this is just a really good kind of a snapshot of kind of how things are looking. So I'm gonna go ahead and add all this up. Okay. Yep. Yeah. So you guys are fine. $1,000 surplus. You know what though? I mean, just because I have $1,000 surplus doesn't mean that I'm gonna feel comfortable spending $100 on a dozen eggs, because the value is just not there, right? So let me just be clear. Again, I'm repeating myself on purpose, okay? I'm not here to sell you anything you don't want, and I'm not gonna assume that you don't want the most coverage that you qualify for. So I always start there, but make no mistake, we're starting there, okay? If you feel great about it and you wanna put the money toward it, then I will support that. But I've done this thing long enough where I know that whenever somebody says something like, I gotta think about it, that's a polite way of saying, that's too much money, get the heck out of my home right now, right? So let's just have an agreement that if it's too much, just say, Dan, it's too much, okay? Because the rates are set by the carrier. I can't change the rates, but I can adjust the coverage down. In other words, the months of mortgage payments down, I can reduce that, okay? Fair enough?
Yeah.
Good, okay, awesome. So here's what I'm thinking right now. Right now, the most that you qualify for would be a program, knowing that it's $2,200 a month for your monthly payment. I want you to imagine this, okay? So you're gonna have the rest of your life, you're gonna have coverage, okay? It's gonna be enough coverage to provide for each other up to 30 months of mortgage payments. Now, if, God forbid, a tragedy happens and there's a car accident, or you trip on a curb and fall and break your rib, which punctures your heart and you die, it's an accidental bodily injury that causes your death, then it will double the payout. So it's up to 60 months of mortgage payments, okay? That's for both of you. Now, at any time between now and the rest of your life, you're diagnosed with a terminal disease, you can take the money, the 30 months, the equivalent of 30 months of mortgage payments, you can take that in advance to pay off the home, pay down the home, whatever, get out of that home, to use the money if you want to go ahead and pay for medical bills, whatever you really need, you have that option to do that, okay? So any terminal disease coverage, or terminal disease that you have is gonna be part of that. And then that program so far, that makes sense?
Yeah.
Okay, so that program for both of you, it covers both of you, okay? The most you qualify for is $852.85 a month. Okay? What do you think?
Yeah, that's gonna be way too much.
I'm really glad you said that, because I'm thinking, if you really think you need that, I don't think you need that. I don't. It's the most you qualify for, like I promised, so I always start there. But I don't think you need that. I really don't. So I put together another couple options for you as well. We would just back down the coverage, okay? 30 months is great, okay? That's 2.5 years of mortgage payments. So what I would usually do at this point is I would back down the coverage. I would say, let's do 16 months, okay? And it's not $852 for 16 months. It's the same, everything else is the same, but it's just less months of mortgage payments. Now we're talking about 1 year and 4 months, okay? And then this would double if either of you are killed in an accident, okay? But if we did that, not $852, now we're cutting it way down. So we're at $435.50 a month. I'm assuming that's a lot better, right? What do you think?
Yeah, that's a lot better.
And everything else stands the same. Terminal disease coverage, you get the peace of mind from that. If you win the lottery, right, and you wanted to cancel, you could always do that down the road, right? 10 years, 15 years, whatever. But this provides each other 16 months of mortgage payments. So tell me what you think, because we can always back down from here. It's your peace of mind. You definitely have the money for it, but I want you to be comfortable. I don't want it to be one of those things where you're like, oh my gosh, that bill's coming, we just don't have the money. Because if you cancel the coverage in 3 months, I haven't helped you at all. This is peace of mind, and it needs to be affordable. So tell me what you want to do.
I think we'll move forward.
Okay, you sure you don't want to back it down? I don't want to twist your arm, I just want to make sure. No doubts?
Let's look at the little one.
She makes some old.
Okay, let me ask you this. At this point, we can go in one of two different ways. Number one, we can reduce your coverage down to get the price down, because you need the majority of financial protection if your husband dies, right?
Why don't we just get rid of her protection, just do mine?
We can certainly do that, but like I said before, if you think that's you're gonna be comfortable with that, you're gonna need to come up with the money for the burial, for the funeral. We can reduce her down, and I usually recommend that we do something on both of you. It's not so much to get you financial relief, but it is enough to get the cost of the funeral, final expenses, just enough to take care of that. That's what I would recommend. But it's your call.
Yeah, we'll go with that.
Okay, great. Well, all I'm gonna need is a photo ID for both of you, and then I just need to see the checkbook. You don't have to void the check or anything, it's all electronic. And then we can move forward from there. Does that sound good?
Yeah, that sounds good.
Okay, so what we need to decide is how much coverage that we want to put on your wife. So as far as that goes, a couple options that I had, we could go ahead and do the equivalent of a funeral. Typically nowadays, we're looking at about $15,000. That would again be paid in a lump sum.
Cremation.
Cremation, so you wanna do less than 15,000? Now we're talking final expense coverage. Okay, 10, does that work?
10 will work.
10 will work, okay, yep. So then if we did that, then what we're looking at is, for you, it's going to be two payments, because remember I told you it's two separate policies. You would own and control your own, each of you, okay? And so the way that this breaks down, the $435.50, which is gonna be, we're gonna go lower than that though, because we're reducing your wife's down to 10,000. Yep. So then your portion of the bill per month, okay, is gonna come to $253.23. Okay, and hers, because we're reducing it down, hers is only $90. So now it's less than the $435 that you already committed to. So what we're doing is we're bringing this down. It's gonna be $343.23. Not too shabby.
Yeah, that's good.
Great, all right. I'll let you guys go ahead and grab that. I'm gonna go ahead and pull out my laptop, and then we'll get this process started, okay?
Nice.
Okay, great.